Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024, May-June, Paper 1-2. This is Paper 1, which consists of 30 questions. Each of them will be of 1 mark, and the total time limit for this paper is 1 hour. And in this video as well, we'll be attempting to complete this paper under 1 hour. So without any further delay, let's get started. For the first question, which statements relate to a sole trader? The first one is that the business is a separate legal entity. This is incorrect because a sole trader will have unlimited liability. It means that all of the losses of the business will have to be paid by his personal property as well. The second one is there is no separation between ownership and control. This is also true because the sole trader will own the business as well as control the business. The third one is some of the profit is used to pay interest on the owner's capital. This is incorrect because there will be only a single owner, so we do not really have to pay any interest on capital as part of a sole trader business. The fourth one is there is no legal requirement to keep full accounting records. This is true because we're talking about sole trader, so he doesn't really have to show all of his financial statements to any outside party, so there is no any legal obligation. So the correct answer we're looking for is 2 and 4, which is given by option D. That is all for the first question. Let's move towards the next one. Which item incorrectly applies the matching concept? The first is capitalizing staff expertise and writing it off over the working life of the staff. This is true because we cannot really capitalize staff expertise because this is subjective. One person might say that some staff's expertise is worth 10,000, whereas another person might say that no, it's worth 11,000. So we cannot really come to an agreement and express the staff expertise into monetary value. So this is an incorrect application of matching concept and the answer we're looking for. Regardless, let's take a look at the remaining options as well. Including a value for unused stationery in the statement of financial position. This is true because we can classify the unused stationery as our inventory, closing inventory. So this is the correct application. The third one is providing for irrecoverable debts in the year the sales took place. This is because we have to match the losses to the revenue of that particular year. Then the fourth one is recording telephone costs incurred but not yet billed. This is application of accrual concept, which is also the matching concept. So this is true. That is all for the second question. Let's move towards the third one. Goods that had previously been purchased on credit have been returned to the supplier. How should this be recorded in the purchaser's book of account? Okay, so in this case, we are returning the purchased goods and these were purchased on credit. It means that we do not receive any money into our bank account and we're talking about purchases returns, which will definitely be the account to be credited. So A and C are correct. Now for the debit side, since there is no cash to be returned, bank on the debit side would be incorrect. So it leaves us with the correct option, C. This will reduce our trade payable because we've already returned the goods. It means that the amount that we have to pay back to the credit supplier will be lower than what it previously was. That is all for the third question. Let's move towards the next one. Jason sold a non-current asset with a carrying value of 8,000. So this is the net book value. He mistakenly recorded this by debiting the bank account and crediting the sales account with the proceeds of 6,500. By which amount was the profit for the year overstated? Okay, there are two things to notice here. Instead of recording this as sales proceeds, we included this as sales. So clearly our sales has been overstated by 6,500, which means that the profit has been overstated by 6,500, right? So the first overstatement is recording of the sales proceeds as the sales for the year. Then the second thing is we also need to include any profit or loss on disposal. In this case, the net book value is 8,000, but we only received 6,500. So there is a loss on disposal. And the loss is the difference between our sales proceeds and the net book value. This results in the value of 1,500. So 1,500 loss was not included. Since this was not included, it definitely means that the profit was again overstated by another 1,500 because this should have been subtracted initially. So this will also be added to the overstated amount and this results in the total overstatement of 8,000. This is the answer we're looking for, which is given by option D. That is all for the fourth question. Let's move towards the next one. Adam's financial year ends on 31st December. At the beginning of the year, on 1st January, the carrying value of machinery was 20,000. So this is the net book value. During the year on 30 June, he purchased a new machine for 6,000. This is the cost of the new machine. He paid 50% of the cost in cash and the balance by part exchange of an old machine which had a carrying value of 2,500 on that date. Okay, so the sales proceeds or the part exchange value in this case is 50% of this cost. So 6,000 times 50%, which results in 3,000. And the carrying value is 2,500 of this part exchanged machine. He depreciates his machinery by 20% per annum on the carrying value calculated on a time basis. What is the carrying value of the machinery shown in the statement of financial position at the end of the year on 31st December? Okay, we also need to provide for the depreciation of this year. Let's calculate that. Let's start with the opening carrying value of 20,000. Now let us remove the carrying amount of the old machine. We will calculate the depreciation on that separately since we need to calculate it on a time basis. So minus 2,500. So the remaining machine will be used for the entire year. So we can just multiply it by the rate of 20% per annum. Then for the disposed machine, we have the carrying amount of 25,000, and if we multiply it by 20%, we get the depreciation for the entire year. But it was disposed on 30 June, which means that we used this old machine for the months of January, February, March, April, May, and June. So we used it for 6 months. So times 6 by 12. Then we also purchased a new machine with the cost of 6,000 on that same date. Right, so 6,000 times 20% will give us a depreciation on the entire year. But this new machine was only used for the months of July, August, September, October, November, and December, which is again 6 months. So times 6 by 12. This results in the depreciation charge for the year to be 4,350. Now, the carrying value of the machinery to be shown in the statement of financial position is 20,000. Then we need to remove the disposed vehicles carrying amount of 2,500. Then we need to include the cost of the new machine of 6,000. And we need to subtract the depreciation charge for the year of 4,350. This results in the value of 19,150, which is given by option C. That is all for the fifth question. Let's move towards the next one. Which statement describes a limitation of reconciliation and verification procedures? The first one is sometimes the sales ledger control account balance does not agree with the total of the sales ledger account balances. This is due to the presence of some errors, and after we rectify those errors, surely the balance of the sales ledger control account will be equal to the total of the sales ledger account balances. So we cannot really classify this as a limitation of reconciliation. For the second one, errors of commission could be present in the books of account. So error of commission is something that cannot be disclosed by preparing our trial balance or by our reconciliation and verification procedures, which is why we can classify this as a limitation, and this is the answer we're looking for. Let's take a look at the remaining options as well. Bank transactions may be missing from a bank column in the cash book. If any bank transactions is missing, those will be included by preparing a bank reconciliation statement. So we cannot classify this as a limitation. The fourth one is the totals shown in the trial balance do not always agree. This is true because of the presence of some errors, and those will be rectified by preparing a suspense account, which also falls under reconciliation and verification. So this is again incorrect. That is all for the sixth question. Let's move towards the next one. The following errors in the accounting records have been found and corrected. The first one is a purchase invoice for 250 was omitted from the books of accounts. A sale of 120 to X was debited to the account of Y. This is an error of commission. We recorded the correct amount on the correct side but under the wrong heading. Then the sales journal was overcast by 100. The gross profit for the year before correcting the errors was 60,200. We need to calculate the correct gross profit. We start with the incorrect one, 60,200. The first one is that the purchase invoice for 250 was omitted. So purchase was understated. So we need to include this 250 under purchases, which is added under the cost of sales, and the cost of sales itself will be subtracted while calculating the gross profit. It means that we just need to subtract this 250 in order to correct it. Now for the second one, a sale for 120 to X was debited to the account of Y. We've already classified this as error of commission, which will have no impact on our gross profit because regardless, the sale amount of 120 was correctly recorded. Only the heading was different. For the third one, the sales journal was overcast by 100. So we need to subtract the sales by 100. So it just means that we need to subtract 100 here. And this results in the amount of 59,850. This is the correct answer we're looking for, which is given by option A. That is all for the 7th question. Let's move towards the next one. The bank statement of a business showed a credit balance of 3,421. This is a credit balance shown by a bank statement, which means that this is a positive amount, which did not agree with the balance in the cash book. Further investigation revealed that a receipt entered in the cash book for 125 and a payment for 455 had not yet appeared on the bank statement. The bank statement showed bank charges of 64 and a credit transfer of 177, which had not been entered in the cash book. Which balance was shown in the cash book before making the necessary changes and preparing a reconciliation statement? Okay, so we need to work our way backwards. We first need to prepare the bank reconciliation statement, and we will start with the balance as per the bank statement of 3,421. Then we have receipt of 125 not yet entered in our bank statement. So this will act as our uncredited deposits, which we need to add. Then we have 455 as a payment not yet recorded in the bank statement. This will act as the unpresented checks, which we need to subtract. And this will give us the balance as per the updated cash book. So this is the balance after making the necessary changes. This results in the value of 3,091. Okay, now let us prepare the cash book. So we have the closing balance of 3,091. We're trying to calculate the opening balance. This is the balance before any changes were made. And in this case, the bank statement showed a bank charges of 64, which had not been entered in the cash book. This is definitely an expense, and within our cash book, all of the incomes will be recorded on the debit side and expenses on the credit side. So the 64 will go on the credit side, and a credit transfer of 177, which had not been entered in the cash book. Now in this case, the credit transfer is basically a receipt that was not yet recorded in the cash book. So this will act as an income, which means that it should be recorded on the debit side. Now in order to calculate the opening balance, we need the total from the credit side. That will be 64 plus 3,091, which results in the value of 3,155. So 3,155. And for the opening balance, that will be 3,155 minus 177, which results in 2,978. This is the balance shown in the cash book before making the necessary changes. And the correct answer is given by option A. That is all for the 8th question. Let's move towards the next one. Which statements describe the benefits of preparing control accounts? The first one is assists in detection of fraud. This is true because the control account and the ledger balances are kept by two different members of staffs. The second one is assists in finding error of original entry. So errors of original entry cannot be disclosed by control accounts. This is incorrect, because if we do not enter it within our book of prime entry, then it will no longer be entered within our ledger balances as well as the control accounts. The third one is assist in finding transposition errors. So transposition errors might be figured out by preparing the control accounts, because the basis for the ledger balances and the control accounts are different. Control accounts are prepared by taking the book of prime entry as our reference, whereas the ledger balances will be prepared by taking the individual customer or supplier account as our basis. So 3 is correct. And the fourth one is assist in preparation of financial statements. This is definitely true because the control accounts will give us the correct balance for our trade receivables and trade payables. So the correct answer we're looking for should include 1, 3 and 4, which is given by option C. That is all for the 9th question. Let's move towards the next one. A trade payable for 720 transferred from the purchases ledger has been entered on the wrong side of the sales ledger control account. The sales ledger control account had a closing balance of 92,460 before correcting the transfer, and allowance for irrecoverable debts of 1,000 is to be made. We need to calculate the correct balance on the sales ledger control account. Okay. So in this case, the opening balance of the sales ledger control account will be 92,460. We have been given some information regarding allowance for irrecoverable debts, but remember that within the sales ledger control account, we only include the irrecoverable debts, not the allowance for irrecoverable debts. So we can completely ignore this for now. Let's focus on the transfer. A trade payable for 720 was transferred from the purchases ledger, and it had been entered on the wrong side of the sales ledger control account. Since we're talking about purchase ledger balance being transferred, this is similar to contra. So contra would definitely go on the credit side, but instead it had been entered on the wrong side. So previously we entered it on the debit side. So we want the correct value of 720 on the credit, but we already have 720 on debit. Now in order to correct it, if we enter it once on the credit side, it will just get cancelled out. So we need to enter it again so that the correct balance is shown. It means that in total we will have to record 720 twice, which is 1440 on the credit side of our sales ledger control account. Now let's calculate the closing balance. The total on the debit side is 92,460. Now the closing balance will be 92,460 minus 1,440, which results in the value of 91,020. This is the answer we're looking for, which is given by option B. That is all for the 10th question. Let's move towards the next one. After preparing the draft statements of profit or loss, it was discovered that the purchase of an office computer had been incorrectly recorded in the purchases account. What will the effect of correcting this error be on cost of sales and profit for the year? Since purchase of an office computer is incorrectly recorded in purchases account, the purchases is definitely overstated. As a result, the cost of sales is also overstated. And if we correct it, the cost of sales will now decrease because the correction will just lead to opposite reaction. So we're looking for decrease for cost of sales. Now for profit for the year, there will be a dual impact because we need to consider the gross profit as well as the depreciation. Previously, the cost of sales was higher, it means that the gross profit was lower. And since we included the purchase of the office computer there as purchases, we did not apply any depreciation. So depreciation was also lower. So overall, the profit for the year was understated. Now after correction, everything will just be in reverse. It means that the gross profit will increase because the cost of sales finally decreased. Then once we implement the depreciation, it will also increase. And overall, the profit for the year will also increase because the impact on the gross profit is higher as compared to the impact on the depreciation amount. So we're looking for an increase in the profit for the year, which is given by B and D. So the correct option for both the cost of sales as well as profit for the year is option B. That is all for the 11th question. Let's move towards the next one. The draft profit for a business was 64,000 before the following information was taken into account. An allowance for irrecoverable debts was maintained at 2% of trade receivables. The total of trade receivables was 150,000 at the beginning of the period and 220,000 at the end of the period. Then on the last day of the period, 4,000 was recovered from a trade receivable that had been written off as irrecoverable. Okay, so this was already written off as irrecoverable. This will not have any impact on our calculation for allowance for irrecoverable debts. But now we need to correct it within the calculation for profit for the year because previously this 4,000 was subtracted. But now since it has been recovered, we need to add it back to our profit. So let's start with the draft profit of 64,000. We need to add back the irrecoverable debt. Now for the allowance for irrecoverable debt, let's calculate the opening balance. That will be the opening trade receivables of 150,000 multiplied by the rate of 2%. This results in the value of 3,000. Now for the closing balance, we start with the closing trade receivables of 220,000 and multiply it by the rate of 2%, which results in the value of 4,400. Now we just need to compare these two values. We can clearly see that there has been an increase. And the increase is of 4,400 minus 3,000, which is 1,400. Since this is an increase, it will always be subtracted as part of an expense. So we need to subtract it from the draft profit. Now the revised profit for the period will be 64,000 plus 4,000 minus 1,400, which results in 66,600. This is the answer we're looking for, which is given by option D. That is all for the 12th question. Let's move towards the next one. A sole trader does not keep a complete set of books of accounts. He believes a staff member has stolen some cash. Which items will not be needed to calculate the amount missing? We're talking about cash being stolen, so we basically need to prepare a cash account. So any item which will not impact the cash account will not be required in order to calculate the amount missing. The first one is cash in hand at the beginning and end of the year. This will definitely be included within the cash account, so this is needed. Owner's drawings taken from the bank. This is the drawings taken from the bank, which will be recorded within the bank account, not the cash account. So this will not be needed. The third one is checks received from customer. Again, we're talking about checks which will be recorded in the bank account, not the cash account. And the fourth one is the totals of the cash sales and cash purchases, which will be recorded within the cash account. So the items that will not be needed is 2 and 3, which is given by option B. That is all for the 13th question. Let's move towards the next one. A trader sells goods at a uniform markup of 20%. The following information is available for the year ended 31st December. We have the opening inventory, closing inventory, purchases, carriage inwards, carriage outwards, goods taken for own use. This is at the selling price. What was the value of the cost of sales for the year ended 31st December? Okay. So the cost of sales will include opening inventory. We will add the purchases. We have carriage inwards that will also be added. Then we have goods taken for own use that will be subtracted, and we have the closing inventory that will be subtracted as well. Okay, so we have the opening inventory of 1780. We have the purchases of 23,400. We have the carriage inwards of 700. We have goods taken for own use, but this is at the selling price, but we need to record it within the cost. So we have to use our markup. Selling price will be equal to cost times 1 plus markup, which is 20% in this case. We have the selling price of 1800. We are trying to calculate the corresponding cost. So times 1.2. This will result in the cost being 1800 divided by 1.2, which results in the value of 1500. Then we also need to subtract our closing inventory, which is 2100. This results in the value of 22,280. This is the answer we're looking for, which is given by option C. That is all for the 14th question. Let's move towards the next one. Both partners in a business have a credit balance on their current account. How does the inclusion of interest on drawings affect the financial statements of the partnership? So if we include the interest on drawings, it is something that will have to be paid by the partners to the partnership. So this will go on the debit side of the current account. And if it goes on the debit side, it means that the current account balance will decrease, which is given by option A and B. Then we have the shares of residual profit. Okay, so for the shares of residual profit, we need to follow the format of appropriation account. And within the appropriation account, the interest on drawings will be added because this is something that the partnership will receive from the partners. This will definitely increase their shares of residual profit. So that is given by B and D, and the correct answer for both of these is given by option B. That is all for the 15th question. Let's move towards the next one. Vikram and Walter are in partnership but have not made any partnership agreement. The net assets of the partnership at the end of a financial period total 180,000. This is asset minus liability, which means that this is the total of the capital account and the current account. Then the partners maintain capital and current accounts. The opening balances on the current accounts is given below. Vikram has a debit balance whereas Walter has a credit balance. The profit of the partnership for the period before appropriation was 85,000. Vikram had provided a loan of 20,000 to the business. What is the balance on Vikram's capital account at the end of the period? First of all, we need to prepare the current account because we only have the opening balances of the current account. So we first need to calculate the closing balance of the current account so that we get the capital account balances. Okay, so I'm just going to prepare the amounts column and not write down any details. These two will be the debit side, these two will be the credit side. We have Vikram and Walter. Okay, Vikram has the debit opening balance of 3,200. Walter has a credit opening balance of 6,800. Then Vikram provided loan, and we know that there is not any partnership agreement. So the interest on loan will be at 5%. That will be 20,000 times 5%, which results in 1,000. This will be received by Vikram. So this will go towards the credit side of his current account. So 1,000 right here. Then we have the profit before appropriation of 85,000. And again, in this case, there is no partnership agreement, which means that there will be no interest on capital, no interest on drawings, and no salaries. So this will be our residual profit. And due to the absence of partnership agreement, this will be divided equally among Vikram and Walter. So Vikram will receive half of it and Walter will receive the remaining half of it. Half of 85,000 is 42,500. So So this will be the share of residual profit, which will again go towards the credit side of their current account balances. So we have 42,500 and 42,500. That should be all. Now their closing balances will be on the debit side. So we first need to calculate the total from the credit side. For Vikram, that will be 1,000 plus 42,500, which is also 43,500. So the capital balance will be 43,500 minus 3,200, which is also in 40,300. Now for Walter, the total on the credit side will be 6,800 plus 42,500, which is 49,300. And that will act as his closing balance. Now if you bring this down to the other side, this will be the credit balance, right? So for both the partners, we have a closing credit balance from the current account. Now capital plus the current account of 40,300 and 49,300 will be equal to the value of 180,000. It means that the total capital will be 180,000 minus 40,300 minus 49,300, which results in 90,400. Again, there is no partnership agreement, which means that this capital balance will be split equally between the partners. So Vikram's capital will be 90,400 divided by 2, which results in the value of 45,200. This is the answer we are looking for, which is given by option B. That is all for the 16th question. Let's move towards the next one. Which row correctly shows an example of a capital reserve and an example of a revenue reserve? For capital reserve, we have general reserve. General reserve is created by transferring the money from the retained earnings, and retained earnings itself is a revenue reserve. So general reserve is also a revenue reserve. This is incorrect. And for the second one, again, we have retained earnings. Like I said before, retained earnings is a revenue reserve. So this is also incorrect. Revaluation reserve is created by revaluing our assets. So that is part of our capital reserve. This one is correct. And we have share premium, which is also part of our capital reserve because we get share premium by issuing shares. Now for revenue reserve, we have retained earnings, which is correct. Revaluation reserve, which is incorrect. This falls under capital reserve. We have share premium, which is again a capital reserve, and a general reserve, which is a revenue reserve. So the correct answer for both of these is given by option D. That is all for the 17th question. Let's move towards the next one. On 1st January, a company makes a bonus issue of 10,000 ordinary shares of 0.50 each. During the year, it makes a rights issue of 15,000 ordinary shares for 0.6 each. So the shares are being issued at a premium right here. What is the effect of these in the statement of financial position? So share capital and reserves increase. Remember that bonus share has no impact on the total share capital and reserve because we do not issue shares using outside resources. We just use our existing reserves in order to fund the ordinary shares. So we need not calculate the effect of the bonus issue. Let's just focus on the rights issue. So due to the rights issue, we will gain 0.60 for 15,000 shares. So that will be 15,000 times 0.6, which results in the value of 9,000. So our total share capital and reserves will increase by 9,000, which is given by option A and B. And we have current assets increase. So current assets will include any monetary income, right? And whenever we make rights issue, it means that the existing shareholders will have to pay 9,000 into the bank account, which is part of our current assets. So it just means that the current assets will also increase by 9,000 itself, which is given by option A and C. So the correct one for both of these is given by option A. That is all for the 18th question. Let's move towards the next one. An accounting student made the following statements about the requirements of different users of the accounting information of a company. Which statements are correct? The first one is that the government wants to assess the company's return on capital employed. The government do not want to know the company's return on capital employed. It will only be invested in the company's profit so that it can value the tax that will be gained by the government. So first statement is incorrect. Second one is that the suppliers want to know if the company is financially stable. This is true because suppliers most often will have to sell goods on credit. So they definitely want to know whether or not the business is stable enough to pay them back in the future. The third one is that the managers use the information for planning and control purposes. This is true because there are various internal financial statements that will be prepared in order to take correct decisions as well as planning. The fourth one is the lenders want to know whether the business is able to pay dividends. Lenders will only be interested to know whether the business is able to pay the interest, not the dividends. So the correct statements will be 2 and 3, which is given by option D. That is all for the 19th question. Let's move towards the next one. What could improve the current ratio of a sole trader? So current ratio is just current assets divided by current liabilities. For it to improve, current assets will have to increase and the current liabilities will have to decrease. The first one is delaying payments to credit suppliers. So if we delay the payments to credit suppliers, our trade payables will remain intact and it will not decrease, which means that the current liabilities will not decrease. So this is not what we're looking for. Second one is encouraging credit customers to pay promptly. If we encourage them to pay promptly, it means that we will receive cash. But remember, current assets include both cash as well as trade receivables. So if the credit customers pay promptly, the trade receivables will decrease and the cash will increase by the exact same amount. So the overall impact on the current asset will be 0. So this is also not what we're looking for. C is purchasing all inventory on credit. If we purchase all inventory on credit, it means that we will have higher trade payables, which is part of current liability. But we want the current liability to decrease, not increase. So C is also incorrect, which leaves us with option D to be the correct answer. Option D is to reduce monthly cash drawings. If we reduce the monthly cash drawings, it means that the cash will increase within our current assets and we want the total current assets to increase. So this is what we're looking for. That is all for the 20th question. Let's move towards the next one. Which ratios will identify the highest profit for the year for a business? We're looking at expenses to revenue ratio and non-current asset turnover. So expenses to revenue ratio should be lower for us to have a higher profit, and non-current asset turnover should be higher so that we get a higher return by utilizing whatever non-current asset we have within the business. So we're looking for higher non-current asset turnover and lower expenses to revenue ratio. So we have 18 and 18 as part of our expenses to revenue ratio. So it's going to be one of these two. And for non-current asset turnover, we have 4 and 6, and we want the higher one, which is 6. So the correct one for both of these will be given by option B. That is all for the 21st question. Let's move towards the next one. A business provided the following information at 31st March. We have inventories, trade receivables, cash and cash equivalents, trade payables and other payables. What is the asset test ratio? So asset test ratio is just our current assets minus closing inventory divided by the current liabilities. In this case, we have inventories right here, so we can just exclude it. So let's write down the remaining current assets. That will be the trade receivables of 785,000 plus cash and cash equivalents of 15,000. Then for the current liabilities, we have 365,000 as the trade payables and we have 85,000 as other payables. So this results in the asset test ratio to have the value of 1.78:1. This is the answer we're looking for, which is given by option A. That is all for the 22nd question. Let's move towards the next one. A company pays its employees 6.8 per hour for a basic 40-hour week. An overtime premium of 50% is payable together with a production bonus of 0.25 per unit for all units produced over 350. Employees are guaranteed a weekly wage of 330. One employee worked 45 hours last week and produced 410 units. What was the employee's gross pay that week? Okay, first of all, let's include the basic hourly pay. For 40 hours, they will receive 6.8 per hour. So that is 40 times 6.8. For the remaining 5 hours, they will get an overtime premium of 50%, right? So we will pay the regular rate of 6.8 along with additional 50%. So that will be 1 plus 50%. And we have a production bonus of 0.25 per unit for all units produced over 350. So the excess units in this case is 410 minus 350, which results in 60. So for these 60 units, they will also receive 0.25. This will result in the value of 338. And remember, we have a guaranteed weekly wage of 330. Since this is the minimum value that will be received by all workers, we need to compare it to the amount that we just calculated. We have 338, which is higher than 330. So this is the answer we're looking for, which is given by option B. That is all for the 23rd question. Let's move towards the next one. When are unit costing and job costing principles applied? So based on the given options, unit costing will be applied in continuous operations, not for a special order, so A and B, whereas job costing is applied for a special order or a unique item. So that is given by B and D. So the correct answer for both of these is given by option B. That is all for the 24th question. Let's move towards the next one. a hotel provided the following information for a 30-day period. Okay, we have rooms with 2 beds, rooms with 1 bed, number of letting rooms, average number of rooms occupied per day, number of guests in the period of the 30 days, average length of stay, payroll and cleaning cost. What are the average payroll and cleaning costs per occupied bed per day? So we can start with the total of the payroll and cleaning cost for the entire 30 days, which is 300,000. Then we can divide it by 30 so that we get the payroll and cleaning cost per day. And we need to divide it per occupied bed per day as well. So we have rooms with 2 beds, 150 rooms, which means that the number of beds there will be 150 times 2. Then we have rooms with 1 bed and the occupied rooms will be 50. So we get a total of 350 beds. We need to divide it by the 350 as well. So this results in the required answer to have the value of 28.57. This is the answer we're looking for, which is given by option B. That is all for the 25th question. Let's move towards the 26th one. Which 2 factors would mean fixed overheads are underabsorbed? So there will be underabsorption whenever the budgeted overheads is lower than the actual overheads, or when the budgeted production is greater than the actual production. So we're looking for these 2 criteria. Okay, we have the output right here, which is equal to production. So we're looking for budgeted production greater than actual production. And we have it right here. Actual output is less than the budgeted output, so 3 is correct. And we have the actual hours. And the second criteria we have is for the hours. Again, we can tie it up to production itself. We want the actual production to be lower, which means that the actual hours should also be less than the budgeted hours, which is given by statement 1. So the correct answer should include 1 and 3, which is given by option A. That is all for the 26th question. Let's move towards the next one. A company has a positive margin of safety. How did this arise? Margin of safety is just the actual sales minus break-even sales. So there will be a positive margin of safety if the actual sales is greater than the break-even sales, which is given by option A. That is the answer we're looking for. Let's take a look at the remaining options as well. Actual sales are greater than budgeted sales. We do not have budgeted sales within our formula, so this is incorrect. Third one is break-even sales are greater. That would be incorrect. And budgeted sales are greater than actual sales, which is again incorrect. That is all for the 27th question. Let's move towards the next one. A company makes 3 products, X, Y, and Z, for which details per unit are as follows. We have been given the selling price, direct material cost, direct labor hours. Direct labor rate is 8 per hour, and the direct labor hours are limited. In which order should the products be ranked to achieve the maximum profit with the available labor hours? The first thing we need to do is calculate the contribution per unit, and for that we need the direct labor costs per unit as well. In order to calculate the direct labor cost, we just need to multiply the direct labor hours to the rate per hour. So for product X, that will be 0.5 times 8, which results in 4. That will be 2 times 8, which results in 16. And for Z, that will be 2.5 times 8, which results in 20. Now let us calculate the contribution per unit. That is just going to be the selling price minus our variable cost. So that will be selling price minus direct material cost minus direct labor cost. So for X, that will be 18 minus 4 minus 4, which results in 10. For Y, that will be 35 minus 5 minus 16, which results in a value of 14. For Z, that will be 50 minus 5 minus 20, which results in the value of 25. Now we need the contribution per unit divided by the limited factor, which in this case is direct labor hours. So for product X, that will be 10 divided by 0.5, which results in 20. For Y, that will be 14 divided by 2, which results in 7. And for Z, that will be 25 divided by 2.5, which results in 10. Now let us rank on the basis of highest value for contribution per unit divided by direct labor hours. So rank 1 will go for product X, rank 2 will be for product Z, and rank 3 will be for product Y. So the order of production will be X, Z, Y. This is what we're looking for, which is given by option D. That is all for the 28th question. Let's move towards the next one. The details of a planned college course are as follows. We have the course fee per student, variable course cost per student, total fixed cost of the course. The budgeted number of students is 10. However, if a lower fee is charged, 20 students are likely to take the course. How much should the course fee of 100 be reduced by to earn the same total profit from 10 students as from 20 students? Okay, so for the 10 students, we have the number of students multiplied by the course selling price minus the variable cost of 20, so that we get the contribution per unit. Then we need to subtract the total fixed cost of 480, so that we get the profit. And the profit in this case will be of 320. Now we need the same profit by changing the number of units as well as the selling price. Now the number of units or the number of students in this case is 20. We do not know the selling price. The variable cost will stay the same, fixed cost will stay the same, and we want the same level of profit as well. Let's solve this. So the selling price minus 20 will be equal to 320 plus 480 divided by 20. This will give us the selling price to be 320 plus 480 divided by 20 plus 20. This results in the new selling price to be 60. So the course fee should now be reduced by 100 minus 60, which is 40. This is the answer we are looking for, which is given by option C. That is all for the 29th question. Let's move towards the next one. Which statement applies for cost volume profit analysis? The first one is that the fixed cost per unit stay the same over a period. This is not true. Fixed cost per unit will not the same, but the total fixed cost will stay the same. The second one is inventory levels change over a period. This is incorrect because we assume that all productions will be sold. The third one is that the selling price per unit stays the same over a period. This is the correct one. Let's take a look at the fourth one as well. Variable cost per unit change over a period. This is incorrect. We want the variable cost per unit to stay the same over a period. So that is all for this paper. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.